Middle-income earners are continuing to feel the squeeze of the cost of living crisis, with only 19% of those aged between 32 to 40 in the UK feeling prepared for retirement, according to Aviva. CNBC's Activating Wealth series looks at the best ways to preserve your wealth in an environment of high rates and persistent inflation. Laura Suter joins us now, Head of Personal Finance at AJ Bell. Laura, it's been an interesting decade or so for a lot of investors where they've had to chase more risk on assets with very, very low interest rates. Now we have a much higher interest rate. Is it just as simple as putting money away and saving on a consistent basis?
So clearly that is going to really help build your savings up over time. Is if you get into that savings habit and you're saving a set amount of money each month, and then you increase that as your wages grow or as you get bonuses. But I think it's a really interesting time for investors at the moment. As you say, we've had that such long period of low interest rates. We're now in a position where you can earn decent returns on cash. And actually, now inflation is falling, you can earn higher than inflation on cash. And that makes it a very tricky conundrum for some investors when they're thinking about investing for the long term versus how much they should have saved in cash and making use of those high cash rates. I think one of the really key things, though, when we're thinking about cash and the fact that interest rates have risen, is that people really need to engage with their cash, think about how much money they need to have in it, and switch around to the best bank accounts. People think, oh, interest rates have risen, that's great for my cash returns. But if you haven't moved your bank account in a year, then it's very likely that you are not getting those highest rates that you could be. And it's very easy and quick to switch now to maximize your returns there.
Laura, over the years, we've been talking about millennials who've been asset light. Do you think they are still asset light at this point? And are they squandering the opportunity to save for retirement?
I think millennials have a really tough balancing act. They come out of university often with very high levels of debt and having to pay that back once they work. They find that getting on the property ladder is really hard. House prices have risen dramatically, and you need to have a really large deposit or some family wealth to help you out to get on that property ladder. And then at the same time, people are saying, well, you should be saving for a retirement. You should be putting money away for that. And it's quite hard to see how their budget can stretch in all of those directions without people either having very high earning careers or ending up having to live a very frugal lifestyle now to be able to afford all of these things. So I can definitely see why some millennials think, I'm just going to abandon the idea of trying to get on the property ladder because it seems like something that's too far away for me. And instead, I'm going to have fun with money. But we do see lots of people are still building up that savings habit. We saw during COVID, people had some spare money and they started investing and really engaging with their savings. And that has continued. Obviously, the cost of living and high inflation at the moment has put another crunch on people's earnings. And particularly when we think about those graduate levels, they haven't had the time in a career to build up decent emergency savings to fall back on if they did lose their job or if they did see these high spikes in energy and food costs that we've seen. So it's definitely been tougher on their budgets. But we see them as a very engaged group of people. They're much more engaged with their finances, with savings, partly helped by social media and social media trends around educating yourself on your finances than I think some previous generations have been.
I want to pick up on your comment about younger people wanting to have fun with their money, because there's been a lot of reporting over the years about the amount of money going onto platforms like Robinhood, trading of cryptocurrencies. Do you think some of the younger demographics are investing wisely in the right amount of risk? Are they owning stocks, for instance, which would have dominated a portfolio in the past, or are they going after the riskier end of town, going after some of the more momentum names and crypto?
I do think that is a danger for some people that started out, particularly those people that got swept up in that investing craze during COVID. A lot of that was driven by single stock investing, the so-called meme stocks, and cryptocurrency. And I think if we take a step back and we look at the core of financial planning and we think about how you should set up your investing, it's relatively unlikely that for people the first port of call would be a very high risk asset like cryptocurrency or investing all their money in one single stock. When we think about that core of investing, it's about diversifying, it's about making sure that the risk matches the risk level that you're willing to take, and it's thinking about spreading your assets. Now, if you're starting out and you're putting all of your money in one single stock, that doesn't follow those rules, and there's a risk there, I think, that people people then see that value fall in money and they write off investing altogether because they've had a bad experience on one stock, when actually if they invested in a broader, probably slightly less exciting, probably have slightly less kind of that risky appeal or of that social media craze behind it. But if we think about investing in kind of a broad global tracker, certainly not as racy, but probably much more appropriate for first-time investors to get to grips with investing, really understand it before they start to make some of those riskier plays.
Laura, great advice with your conversation with Karen. Can I go back a stage? And something a lot of our viewers really want to know, and I think a lot of them are medium earners, but probably even slightly higher than that as well. Pension or ISA? Is there something really obvious to say here?
Both, which is not an option you gave me there. But essentially, I think people need to think about what they're saving for and what their priority is. For some people, that might be getting on the housing ladder, in which case saving in an ISA or particularly a lifetime ISA will be appropriate for lots of people. But they should check the small print. That gives you a bonus on your money from the government towards a house deposit. Something like that would be ideal if they are looking to save for their first home. But you can't ignore the fact that the money saved when you're younger, that has the long period to grow, decades and decades to grow, is some of the most valuable money in your pension. And at the same time, if your employer is willing to match your contributions, that's going to give an extra boost. And that's effectively a free pay rise that you're giving up if you're not paying into your pension. So it would be looking at what your employer offers you, seeing if you can maximize that, while at the same time trying to put some money away to save either for the future or for a house deposit, or for some of the more fun things like going on a really nice holiday in a couple of years' time, or celebrating a big birthday with friends. Investing doesn't always have to be about these things that are super far in the future, like retirement. They can actually be for slightly more shorter term wins, and that can help motivate you towards saving and investing.
Advice. Laura, I have met in my time both Rachel Reeves, the Shadow Chancellor of the Exchequer, and Mr Hunt as well on several occasions as well. They come at the budget of the UK with diametrically opposed views as well. What do we learn from the budget as well? Because the problem is, if you invest based on what Mr Hunt says today, you could face, dare I say it, potentially Mrs Reeves on a future occasion who might reverse it. So is there any way you can arbitrage the budget statement and what you think might happen next?
It's really tricky at the moment. I mean, it's a very interesting time in UK politics, but we know that it's really difficult and there's not that certainty. There's not that knowledge that the government that's in today will be in the next few years, for sure. And so we could see a reversing of some of these things. I think that some of the stuff that Jeremy Hunt did recently are unlikely to be reversed by Labour. If we think about the cut to national insurance, that would broadly align with the Labour policy, and so we wouldn't necessarily see them unwind that. Some of the changes to pensions that we saw earlier this year, that's now been baked into law, so that would be much harder for Labour government to reverse. But yeah, I acknowledge that it is a more uncertain time than usual, and it's difficult to know where politics are going, let alone the economy, fiscal policy. And then also we obviously have the whole conundrum of inflation and interest rates, which is kind of separate to UK politics, but a huge issue for lots of people living in the UK.
Laura, thoroughly interesting and conversation. We've learned a lot as well. So thank you very much indeed for joining us today. Laura Suter, who's Head of Personal Finance at AJ Bell.